Hi, this is Randy Finney with Right Side of the Chart, and this is a market wrap for Wednesday, September 26, 2018. This is actually the second market update today. First public market update, I did one this morning starting before the bell opened, but that was for members. I covered some trade ideas, setups on natural gas, crude, both of which, produced some quick trades today so far. Covered gold and all the other things that we're trading, platinum, the miners, the US dollar. But I want to just cover the broad markets here, put this out as a public post. In the video today, I reiterated my expectation, even though this trend line has not yet or had not yet broken down. I pointed out that we'd have the Fed, we'd see some volatility. That's been my experience. You can almost bank on it that you're going to see knee-jerk reactions, and usually the initial reaction is not the one that sticks. In fact, almost rarely is the initial reaction the one that sticks. So we saw that today. I'll get to that. But here's the significant developments. Forget about the FOMC noise. That is par for the course on trading on any FOMC meeting where you're expecting a rate announcement like today. So we got what we were expecting. It was baked in the cake. We all knew it's 25 basis point rate hike. There was a 95% probability from the Fed funds futures. There it is. Trying to get this out quick. Have to run out of here to go to my son's track meet real quick. But before I do that, I want to just highlight. There it is, 60-minute chart of SPY. This is that trend line I've been harping on. Comes off the late June lows. And so finally, we did get a breakdown today. So there it was. We were dancing on it most recently. Had a little breakdown yesterday that was pointed out in the trading room by member Francis Q, and I acknowledge that. Just that the only thing is it was not impulsive. And I talk about that a lot. When you get a breakdown, you want to see impulsive selling. And what is that? Somebody asked me today, after the FOMC meeting, what does that mean? What are you looking for? This is impulsive selling. One big red candle. These are 60-minute charts. So, and of course, you don't ever want to. I've always said this. You want to avoid taking breakouts, whether they're bullish or bearish, right in front of an FOMC meeting because you do get those whipsaws, the initial reaction, and any breakouts, especially low volume breakouts like this, are just highly prone to failing. But either way, we popped above it. There it is. So sell signal on SPY on the 60-minute chart. Now we go back out to the daily chart, and yeah, there it is. It's yeah. I'm actually just doing this now as I wrapped up. I didn't even look at it before. I've been focused on the intraday charts, trading actively today. So there it is, SPY breakdown in a pretty solid red candle. So that puts a SPY on a sell signal. Anything's possible. Maybe we whip back up, but that's what I've been waiting for, along with a couple other things. So what I said in the trading room right before the close. We're getting more and more check marks. As I mentioned, the Qs already broke down a while ago and have been back testing. I'm referring to QQQ, but I was really waiting to see SPY as well as a technology sector ETF go. That's XLK. Now that hasn't gone yet. You can see there's a very comparable trend line to SPY, and we closed right on it. So this will be, for lack of a better word, there's no certainties in trading, but let's just say the nail in the coffin for now. Let's just use that term if and when we get something similar, an impulsive breakdown and a solid red close on XLK. Because as I said this morning, and I've said it often, when tech breaks, the market breaks, XLK or the technology sector. As of now, we're going through those new rebalancings, and I think they go into place soon. Today, tomorrow, I have to check. I know it was the end of this month sometime. I don't know if it was the last day, but what I'm referring to is a lot of rebalancing, the biggest rebalancing in decades with the S&P, Standard & Poor's with their sector ETFs. So this one will be impacted and some others. Technology will still be one of the largest, I believe. It's still going to be the largest sector in the S&P 500 and always has been and always will be, at least for the foreseeable future, the largest sector within the NASDAQ 100. Recently, it's around 60% or so. So point being, this market isn't going anywhere without tech breaking down, at least not going anywhere to the downside. So there it is, and we'll probably come down if and when that breaks, which I think will be soon. Get a little reaction off this longer-term trend line right here. So like I said, we saw some additional check marks today. Yes, it's an FOMC day, so if you want to dismiss what happened, you can, but I don't think so. I think that, and I made mention in the trading room, somebody mentioned about maybe we'll get another whipsaw knee-jerk reaction, and we could. Again, this is just day one. I usually wait until after the FOMC announcement day. Give it tomorrow, give it a couple days, maybe into early next week. But let's just look what happened. If we talk about, this is what I talk about, standing aside after an FOMC meeting. So let me just do this for you real quickly. If you trade actively, you probably watched this today on your own screen, but I just put a line at 2 p.m. So you can see we kind of meandered along. This is a SPY on a 1-minute chart, not much. And then at 2 p.m. we had a big pop. So let's just zoom in on that pop. Let's do this. It doesn't even look that big when we see the big drop that came afterwards. So there it is. There's a big pop. Let me just move this line away, get rid of that. And you can see, so we popped up and then we faded an almost perfect 61.8 Fibonacci retracement. So we faded about 2/3 of that pop. Then we punched up again higher. And which at one point, bounced off this fib. But if you, again, so these were some of the initial knee-jerk reactions. Overall, if you look at these two legs up, that was a pretty big move in SPY. I'll tell you, let's just do this for fun. Let me get rid of that line and let's measure this out for you. So SPY went from that initial pop after the FOMC, it rallied up 0.3%. Not much. You have a bigger move in the NASDAQ 100. But then as you can see, let me put that back, all of that and then some was faded. So this is your initial reaction. This is what I say so often. I've been saying this for years because I see this happen almost every time there's a big decision. The initial reaction is very often, it's almost always faded, and very often it's not the reaction that sticks. So we saw that here. That reaction was faded and then some, and very impulsively into the end of the day. And looks like we even set up here with some potential flagging action. I don't know. Don't want to read too much into that because this is the squaring off at the close. It's normal to see a tremendous amount of buying come in, especially on a big day like this right at the close. So let's see what happens tomorrow. Like I said, there's still some work to be done, namely XLK. Tech stocks need to break, big FANG stocks. And so there's a little more work to be done to really firm up the case for correction. But as of now, I have check marks, if you will, on QQQ. Go back to a daily chart here. Again, you might be new to my analysis. So this is our uptrend line here off the early April lows. That broke down a while ago. QQQ has been back testing, sort of wedged in this megaphone pattern or ascending, broadening wedge, if you will, between the primary trend line that's been back testing and this minor trend line here. So there's still some work to be done as well. In fact, as much as that fade was today, the fade from the pop after the FOMC meeting, Q's managed to close positive, up almost flat, 0.04%. But they still need to take this out. So like I said, there's still some work to be done here. And that is XLK breaking down, QQQ taking out this minor trend line at 178 level. Let's just look at how much of a fade it was. So from the highs to the lows, if I grab right at the top there, catch the top of that candlestick, go down here, that was a 1.12% fade. It's in the pop-up box to the left there. Pretty big fade, but again, it just managed to bring the Qs back flat. So can't get too excited about this yet if you're positioned short or if you're thinking of shorting. This market is due for correction. I've been saying that for a while. I know it seems like a long time. I think we're getting there, but we'll know. We'll know in the next couple days. They're either going to follow through to what happened this afternoon. And again, we're at some key levels. These are the intraday charts. This is what I call that post FOMC noise, the rips and the dips. So if we get more downside, you can see there's some support levels we closed on. There's QQQ, that's a minor support level. I posted this in the trading room today as well. These two lines, we were up here. I said, break of this trend line here. We had negative divergence on both the NQ E-mini futures on the 15-minute time frame as well as this QQQ 15-minute chart we're looking at. And I outlined these three targets here as my near-term targets with the sell signal to come on a break of that trend line. Boom, we hit it. Hit that first target, pause there for a little bit, and then slice right down. Overshot, a little momentum fueled overshoot, but closed right back there. You can see I had that target, the actual resistance level there at 184.27. We printed a close at 184.21 in QQQ. So right around that second target. And again, this is just near-term stuff. But I did make mention of this in the trading room that the charts are what I refer to as stacked. It's just a term I made up when you have long-term charts, weekly, daily, and then intraday charts all align. And what I mean by that is sometimes I might be watching some bearish developments on the daily time frame, for example, some long-term trend lines, some bearish chart patterns, but they're still forming and they may take time to play out. And when I look down on the 15-minute or 30 or 60-minute charts, I may see a bullish chart pattern or something, the market pull back to support, and I may be going long. So I separate the short-term and long-term time frames. Short-term time frames are like 15-minute charts are good for day trades, very short-term swing trades. But when the charts are stacked, what I mean by that is you go out from time here. Here's a 15-minute chart with negative divergence. You go out to the more significant 60-minute time frame, which is my go-to swing trading time frame. If that chart ever loads, there it is. And we recently had a divergent high there. It shows better on the SPY. We had divergence as well, back testing that wedge. Or that trend line, I should say. Here's that divergence on the daily chart as well. Big divergent high and that wedge, it's broken down, but it really QQQ hasn't gone anywhere because SPY is holding everything up. They wait for each other, so to speak, and that's why you want to see both of those break down if you're a swing trader, not a very active trader, and you're looking to put on a trade, whether long or short. You want to see both SPY and QQQ confirm those buy or sell signals. And then finally, we go out to the weekly time frame, and as I've been talking about, we have this divergent high, which was just recently confirmed with the bearish crossover on the PPO. So now we effectively have a lower high on the PPO as well as the RSI versus higher highs and prices. We're still comfortably above trend. It would take a lot to get us down to, well, not a lot, I shouldn't say, relatively speaking. It's not going to, could happen in one day, but very unlikely. It's about, we're a little over 5%. Actually, we closed at the top of that candle, so I need to grab the top of the candle. And that would say if it took us, let's say, a week or so to get there, it's about 6%, that trend line, the trend line and that 40-week moving average. So there's a buffer there. And at best right now, I think, if these the bearish developments continue to play out, then we come down. We have about a 6% correction. We bounce. But eventually, this wedge is getting ripe. What I mean by that is we're getting to the point where if it's going to break down, it would probably do so soon. So maybe a 6% or so drop, a bounce, and then maybe we'll get another chance to reshort. But a break and a solid weekly close below this trend line, again, that's a long-term trend line in QQQ, comes off the mid 2015 lows, that would give us a pretty powerful sell signal. Something would give us the best sell signal for a swing short that we've had since 2015 when we had this trend line break, which was followed by a drop of, well, there it is, 26% off the highs. Keep in mind that 26% drop, it was real. It did happen in QQQ, but it did not happen in NDX. QQQ as an ETF experienced a mini crash, so it was down more than the Nasdaq 100, but yet the Nasdaq 100 and everything else fell pretty good during that period there. And it was a swift period, and this is what I talk about a lot. Stocks tend to correct and fall a lot faster than they rise. So in that 1, 2, 3, 4, 5, I don't know, let's say about a dozen, a little over, half dozen candlesticks, half dozen weeks, we wiped out, QQQ wiped out, about a year and a half of gains, at least a year. If we go back from this point all the way to the bottom of that candle, yeah, we wiped out, a good year and a half or so of gains in just a matter of, less than 2 months. So that's what happens, especially when valuations and sentiment get excessive, and then you break some well-watched, well-defined trend line and support levels. And you guys heard me harping recently about this 40-week moving average, one of my favorite moving averages to use especially on tech stocks and a tech-heavy index like QQQ. That's the same as the 200-day exponential moving average. And I don't know if I mentioned this in recent videos, but you can see back then they also came in together. And so we had a break of the trend line shortly afterwards, followed by a break of that 40-week moving average, which has done a great job. You can see it there. It's hard to see it because it comes in so well with that trend line. But that's what I'm watching now. That's what I was watching back then. And you can see once trading normalized, we had a choppy sideways trading period for about a year or so. And but once the trend began to normalize, you can see again, you zoom in and you can see it's just underneath there, that red line, the 200 or 40-week moving average has done a bang up job of defining, acting as support and containing the pullbacks in QQQ. So those are the things I'm watching, and we're comfortably above it for now. So let's just see how this follows through tomorrow, and maybe into next week. Will it be another buy the dip opportunity? Maybe. And again, like I said, the Qs weren't down much actually. I guess they finally, there it is. The close was 0.07%, not 0.02. Quick look at IWM. I won't get into specifics on this because we have an active trade on IWM right now on the site. But the small caps are looking better today. I've covered this in recent videos, so I figured I'd follow up. I should tune down these trend lines to a color not so bright. But what I want to focus in on here, and again, I covered this in this morning's video, so this is mostly a recap for members of the site that were able to watch that video. That 169.70 level, give or take, was resistance here. Three times it capped advances. Finally, we broke out above it, and it's acted as support for, gosh, over what, a month now, close to a month, at least a few weeks. And finally, if you see, we zoom in here, big red candle. So IWM has given up the ghost, it looks like to me. We broke this white trend line, which was my original trend line. Then I added this yellow, what I call BOD, or benefit of the doubt trend line, meaning I could come in and capture. This white one had more reactions along it, along the bodies of the candlesticks and or the shadows of the candlestick. But this trend line caught some other candles, and so both those trend lines now and 169.70 are clearly in the rearview mirror. Solid red close. Anything is possible, but I would say this significantly increases the odds that IWM is going lower. It's a breakdown, but like I said, we need the rest of the market. We need tech to come down with it, and I think it'll follow, but we'll see. Next few days should be telling. Okay, last chart. Now I'd have to resize this. I have to run now. I'm going to wrap this video up here. I was going through before the FOMC meeting when everything was just in the doldrums at the holding pattern they usually go into. I was going over some of the market breadth indicators that I use. There's a lot out there, and this is what I've shared in the past. This is the again, this chart's a little squeezed down. I'll need to resize it. It's on stockcharts.com. But NASDAQ new highs, new lows ratio. So that's the NAHLR. And so what you have up top is the ratio of new highs to new lows in the NASDAQ. And down below you have the NASDAQ composite. Um, and what you can see is what it shows here. Let me change this trend line to a different color. I'll just use the box tool here. You can see these divergences. So when the NASDAQ was rising and all of a sudden you had the ratio of new highs to new lows declining, that's a sign of poor market breadth. And you can see this chart covers goes all the way back to 2006. So we encompass both the last bear market and this entire bull market. So you can see the bear market, the bull market, which ended in October of 2007. So there's your bear market, the Great Bear. From it doesn't look like much here because we're looking at the this big bull market that followed. And I'm not using log scaling. It'd be better if this was log scaling, but it's not. Either way, there it is. So you can see the divergences. That's what I like to sniff out. And you can see divergences leading up. Again, that might not look like much, but these were the biggest corrections that we've had, I believe, these two, and certainly this one, in this entire bull market. And you can see they were all preceded by divergence on the NASDAQ new high to new low ratio index. There it is. So the dotted lines show you when the correction started, and the red boxes highlights the correction. So there it is. We've got that now. And I've talked about this for a while. Breadth has been deteriorating on some metrics, not all. There are some breadth indicators that look better than others. I'm going to say that right now. But there are also some like this that warn, that you have fewer and fewer stocks doing all the heavy lifting. It's the same thing I've been saying. A lot of other people have been saying for a long time, and doesn't mean that it's not going to end the way it has always ended in the past. We've always seen when you see market breadth deterioration, I can't recall an instance, and I've been trading and doing this for a long time, where it ever just resolved itself and worked itself out and breadth started picking back up without a correction. It usually continues until you get a correction and things reset. So I just wanted to point that out. We'll wrap it up here. And again, we'll follow up tomorrow. Like I said, there's still work to be done to firm up a case for a correction. We're not far from it. And as I said in the video this morning, I mean, we're sitting right on a lot of key trend lines. Most major stock indexes and sectors are either right on, just above, or in many cases, like I just showed you earlier, just below those trend lines. So when they all go, I think the odds, or the chances, I should say, for a waterfall type sell-off. I'm not talking about a crash. Anything's possible, but just a quick, swift move down. I think that's certainly elevated right now at this time. We're not that far away. It can just be another, 1-2% down on the major indices on tech, and that could trigger that wave of selling. So either that, or we just continue bumping up along these trend lines and have a few stick saves, and NASDAQ broke down, maybe it'll recover and we continue on higher. But like I say, I still favor the downside break soon. We'll see what happens. And again, I'll put an update out there tomorrow and into the end of the week if anything changes. This has been Randy Finney with Right Side of the Chart. Hope you